logic behind each pattern, and different ways to trade them. At last, we're going to make some conclusions about the use of chart patterns and explore some advantages and disadvantages of this trading technique. The goal of this course is to show you the reality of using these patterns, which is something that most trading educators tend to purposefully ignore. Right from the start, I can say that I'm not a fan of these patterns, but I want to create a reference for people to learn the advantages and the pitfalls. So that's why I created this free course. I believe it's a good idea to learn these patterns just for the sake of understanding their limitations. Before we begin, you should understand that this video, just like any other content you will find on my channel and website, is for educational purposes only. This is not investment advice. Trade at your own risk. With that said, let's begin first by talking about how to classify the chart patterns. The chart patterns classification works a lot like the candlestick patterns classification. If you don't know how candlestick patterns work, I have a free candlestick patterns course you can check out in the YouTube card. There are basically two ways of classifying the chart patterns, and they add on top of each other, as we'll see in a moment. The chart patterns are classified by direction and type. Let's begin by studying the first classification, which is the direction of the chart pattern. The direction classification relates to the direction that price is supposed to go after the pattern. Since we are talking about price charts, there are only two directions that price can go, meaning that it can either go up or it can go down after the pattern. When the chart pattern implies that price will go up after the pattern, we classify it as a bullish pattern. When the chart pattern implies that price will go down after the pattern, we classify it as a bearish pattern. Beyond the direction classification, we also have another type of classification that adds on top of the first one, which is the type. There are three types of chart patterns: the reversal patterns, the continuation patterns, and the neutral patterns. The type classification tells what's going to happen with price after the pattern in relation to what was happening with price before the pattern. Let's analyze these three types individually. Reversal chart patterns indicate that price will go in the opposite direction after the pattern is formed. For example, if price is going up and a reversal chart pattern appears, it means that price will go down after the pattern. The opposite is also true, of course. If price is going down and a reversal chart pattern appears, it means that price will go up after the pattern. The continuation chart pattern indicates that price will resume its current direction after the pattern. For example, if price is going up and a continuation chart pattern appears, it means that price will continue going up after the pattern. By the same token, if price is going down and a continuation chart pattern appears, it indicates that price will continue going down after the pattern. At last, we have the neutral chart pattern classification, which means that price can either go up or down depending where price breaks out of the pattern. The way chart patterns are classified is by combining these two types of classifications together. For example, when we talk about a bullish reversal chart pattern, we are talking about a pattern that appears when price is going down in order to signal a reversal to the upside. That's the case because the term bullish indicates what's going to happen after the pattern, which in this case is going up, and the term reversal means that price will change its direction after the pattern. If price will change direction after the pattern and it will go up, it necessarily means that it was going down before the pattern. In a bearish continuation pattern, price will be going down, and after the pattern appears, price will continue going down. In neutral patterns, we don't care about what's happening before the pattern. We simply take a look at which side price breaks out of the pattern, since that's the direction it will probably go. So if you see a neutral pattern and price breaks out to the upside, the pattern is indicating that price will go up. If price breaks to the downside, the pattern is indicating that price will go down. If these classifications don't make much sense to you, they will become clearer as we walk through the examples of each pattern. Let's now move on to the study of the most relevant chart patterns one by one. We will begin exploring each pattern in each classification, starting with the reversal patterns first. So these are the patterns that will indicate a change in price direction after the pattern is confirmed. The first chart pattern we'll analyze is the famous head and shoulders pattern. The head and shoulders is a bearish reversal pattern, and it looks like this. Notice that price will be going up, and after the pattern it will go down. There are a few important elements in a head and shoulders pattern. We have the shoulders, which are highlighted by numbers 1 and 5, the head, which is highlighted by number 3, and the neckline, which is highlighted by the line connecting numbers 2 and 4. This chart pattern receives this name because the price action will resemble the shape of head and shoulders, which is something that makes it easier to remember and detect the pattern in real time. The logic behind the pattern is that price action will make a downward turn by failing to produce a higher high in number 5, meaning that price will reach a peak in number 3, and a failed attempt to surpass number 3 in number 5. All of this means that sellers are gaining power as buyers exhaust their energy. The important thing to pay attention when attempting to trade a head and shoulders is the neckline. This is the line that will tell you when price action breaks out of the pattern, therefore confirming it. And it's also the line that will tell you where to enter the market. The ideal way to trade a head and shoulders pattern is by letting price break below the neckline and wait for price to come back and retest this line. Some people attempt to enter a short trade as soon as price breaks down the neckline, but the problem with that is that you might enter in a much less precise point, so you end up taking more risk and a smaller potential return. As I said, the ideal situation is to wait for price to retrace back up to the neckline, and as price reaches the neckline, it's also important to check for signs that price is indeed respecting the neckline as a resistance. For example, if price comes back to the neckline, and as it reaches it, price creates some sort of bearish reversal candlestick pattern, you can think about going short. This is just one example, of course. There are thousands of different things that can happen if price comes back to the neckline to retest it. So in summary, there are mainly two ways of entering a trade using a head and shoulders pattern. You can wait for price to close below the neckline and use that to trigger a trade at market, which is a more dangerous entry, or you can wait for price to close below the neckline and come back to retest it, also observing how price reacts as it reaches the neckline. Beware that it's certainly possible that price closes below the neckline and then starts to rise again, completely disrespecting the neckline. That's why it's important to enter in the most precise place possible, as it will be less risky. Beyond the entry, you also need a logical stop loss placement and a logical target, and those will depend on the type of entry you choose. The logical stop loss order is above the high number 5 because as price breaks down the neckline, high number 5 will become a confirmed supply zone or a point where sellers confirm their power. If you don't know how supply and demand trading works, check out the Ultimate Beginner's Guide to Supply and Demand Trading in the YouTube card. This is the safest stop loss to use in a head and shoulders. Now you can begin understanding why waiting for price to retrace to the neckline is a better idea. It's because it will diminish the size of your stop.